Hello. Today we are talking about Income Contingent Repayment, or ICR. ICR was the first of 4 income-driven repayment options for federal student loans. It's been around for a while. It was passed by Congress in 1994. It was the first of the 4 options available. And when it was created, it was a great alternative to the standard 10-year repayment plan, which is the default when your federal loans enter repayment. But since then, it's been really overshadowed by the 3 more recent additions. That's income-based repayment, pay-as-you-earn, and revised pay-as-you-earn. Here's how it works. Your monthly payment, if you choose to enter income contingent repayment, is based on the lower of 20% of your discretionary income, or the amount you'd pay under a standard 12-year repayment multiplied by an income percentage factor. And I know that sounds a little bit complicated, so we're going to walk through both of them. Discretionary income under ICR is calculated as the difference between your adjusted gross income and the federal poverty line in your area. This is a little bit different calculation than under IBR pay or repay, which uses 150% of the federal poverty line. Income contingent repayment uses 100% of the poverty line in your area. The poverty line info is published by the Department of Health and Human Services and is revised every couple years. It depends on the number of people in your household and where you live. The income percentage factor that we multiply the monthly payment you'd make under the standard 12-year plan by ranges from 55% to 200%, and it depends on your adjusted gross income. So you make less money, your income percentage factor is lower, and therefore your monthly repayment, or your monthly payment, I should say, is also a little bit lower. This is also something that's updated by the government periodically, and you can look yours up at federalregister.gov. Here's an example. Let's say you get out of school and enter repayment with $100,000 in federal student loans at 6% per year. You get a job that pays you $45,000 per year, or $3,750 per month. That works out under the standard 10-year repayment plan. And again, remember, this is the default repayment option once you get done with school. Your monthly payment is going to be $1,110 per month. And that's almost a third of your gross monthly pay of $3,750. So I don't need to tell you that that's a pretty significant burden. So let's say you enter income contingent repayment. Your monthly payment would be the lower of 20% of your discretionary income, or your monthly payment under the standard 12-year plan multiplied by that income percentage factor. Here's what 20% of your discretionary income would be. We take $45,000 a year, assuming that you're single and you live in the lower 48. The federal poverty line would be $11,880. The difference of those two is your discretionary income, $33,120. Chop that in 12. On a monthly basis, that's $2,760, 20% of which is $552. Under the standard 12-year plan, not the 10, but the 12-year plan, your monthly payment would be $975.85. Again, assuming that you're single, based on an AGI of $45,000, your income percentage factor would be 88.77%, making your monthly payment $866.26. The lower of these two is going to be 20% of your discretionary income, $552. So by entering income contingent repayment, you've effectively lowered your monthly payment from $1,110 down to $552. Not bad. Now, since we're making lower monthly payments than the standard 10-year plan, it's obviously going to take longer to repay your loans. And under income contingent repayment, if you still have a balance remaining after 25 years of qualifying payments, the rest is just forgiven, which is a really great option to have if you're on the lower end of the income spectrum. Just keep in mind that any amount that is forgiven under these programs is considered taxable income. So that's added to your adjusted gross income that in the year that it's forgiven, and you've got to pay tax on it. Also keep in mind that if you're married, your spouse's income is going to be included in the calculation of discretionary income if you file your taxes jointly. You can file your taxes separately and exclude your spouse's income, which may make sense if your spouse makes significantly more than you do. But there are other tax implications of doing that. Typically, you end up paying a little bit more in taxes by filing separately. Again, that depends on a lot of different factors. And your phase out for things like Roth IRA contributions are a lot lower. But in some circumstances, because of the student loans, it makes sense to file separately. Interest capitalization is another important thing to keep in mind. Say that you enter ICR in the example that we gave, and your monthly payment is $552 per month. If the interest that accrues on your loans each month exceeds $552, you're going to have some accrued interest each month, the difference between the amount you're paying and the interest that accrues. Now, you don't pay interest on that interest. In other words, the $100,000 in loans that you have is going to be what the interest is based off of, not the extra interest that's accrued on the side. When interest capitalizes, it's added to the balance of your loan. And under income contingent repayment, any accrued interest is capitalized and added to your loan balances at the end of each year. Doesn't matter whether you stay in the program or not, it's automatically capitalized. And this is one of the big shortcomings of ICR compared to IBR, or pay or repay, is this interest capitalization. So that's the rundown on income contingent repayment. Hope you found it helpful. Be sure to subscribe to Above the Canopy and get free access to the Financial Independence Vault. You'll find a lot of premium content in there, not only about student loans, but other aspects of personal finance. Thanks for watching.